Okay, let's unpack this. We are diving into a cornerstone of financial confidence. The Federal Deposit Insurance Corporation, or the FDIC. For most of us, it's really just that little sticker on the bank teller window, you know? A quiet, sturdy reassurance that whatever happens, our money is safe.
It is, and I would argue it's the single most successful confidence-building mechanism in modern financial history. The paradox is that everyone knows the name, everyone has seen the sticker, but, few people truly understand its incredible operational depth, its complex funding mechanism, and, crucially, how profoundly different the U.S. financial world would be without it.
Precisely. We see that sign assured up to $250,000, but we need to go deeper than just the visual guarantee. What does that promise actually mean? Who is backing that $250,000 commitment? And who, fundamentally, pays the premiums that keep this enormous insurance pool solvent?
Well, that guarantee is often described as the full faith and credit of the United States. That is an incredibly powerful legal and, I think, psychological promise. Our deep dive today relies on some pretty comprehensive regulatory and historical summaries to help us decode that guarantee.
Our mission, then, is to understand how this agency, founded during the chaos of the Great Depression, provides that assurance, how it sets the highly technical rules for coverage, and, most importantly for you, the listener, how you can apply those very specific rules to maximize protection for your own money.
And the most compelling data point that anchors this entire discussion is its success rate. Since the FDIC was founded in 1933, no depositor has ever lost a single penny of FDIC-insured funds.
Not a penny.
That track record is why the FDIC isn't merely an insurance policy. It's a psychological anchor for the entire U.S. economy. It transformed banking from what was a risky venture into, well, a safe utility. We'll start by exploring the staggering instability that made the FDIC necessary, then meticulously break down the complex rules for coverage. And finally, we'll examine how the agency responds when a bank actually fails, detailing its complex dual role as both the insurer and the liquidator.
To truly appreciate the FDIC, you have to look back at the abyss it pulled the country back from. The banking system before federal deposit insurance was, it was structurally unsound. It was based on an assumption of risk that most of us today just can't even imagine.
That's absolutely right. The sources paint a picture of just fundamental fragility. Without any guaranteed insurance, a depositor was taking the risk that the bank could just run out of cash, due to bad investments, loan losses, or unexpected mass withdrawals. The whole system was structured around a concept called the unit bank, which meant banks were highly localized and small. They were often tied to a single community's economic health.
So if the local farm crop failed,
The local bank failed, exactly.
that lack of diversification and the small size meant instability was just rampant, right?
Yeah.
The system was ripe for contagion.
Exactly. The failure of just one small bank in a local community, maybe because of a handful of bad loans, would immediately trigger mass panic. People would hear the news, they'd assume their bank was next, and they'd rush to pull their cash out.
The classic bank run.
These bank runs were not just anecdotal. They were devastatingly effective. They quickly spread losses and withdrawal demands to otherwise solvent banks, causing them to fail too, purely through fear. It was a vicious, self-fulfilling prophecy where confidence, or really the lack of it, became the most valuable commodity.
And this wasn't just some sudden problem in 1929. The data shows this fragility was endemic throughout the 1920s, even during periods of, apparent prosperity.
Yes, the system was already decaying. Between 1921 and 1929, a period we often remember as the Roaring Twenties, approximately 5,700 banks failed. Yeah. And to put that in perspective, there were roughly 31,000 banks in the U.S. at the start of that decade. So a huge chunk. These failures were concentrated in rural areas, particularly the agricultural Midwest and South, where those small local unit banks were common and regulation was, let's say, lax.
So the Great Depression wasn't the start of the problem, but it was the fatal blow that shattered an already brittle structure.
It was the true cataclysm. It was what historians call the Great Shakeout. The scale was just monumental. Nearly 10,000 bank failures occurred just from 1929 to 1933.
10,000.
That is more than one-third of the entire U.S. banking infrastructure wiped out in 4 years. This crisis peaked in February 1933, forcing most state governments to order mass bank closures, the famous bank holidays, just to halt the runs. The country literally stopped transacting cash business because there was zero faith in the institutions holding the money.
Which brings us to the establishment of the FDIC through the Banking Act of 1933.
Yeah.
I mean, this move seems like a no-brainer given the chaos, yet there was immense political tension surrounding it.
Immense tension, and that tension reveals a really deep philosophical disagreement about the role of government in finance. The public was overwhelmingly in favor. I mean, they wanted their money protected, but institutional forces, including the very man who signed the bill, were skeptical.
You're referring to President Franklin D. Roosevelt. He initially resisted the idea of deposit insurance, viewing it as potentially destructive.
That's the classic moral hazard concern. Roosevelt worried that guaranteeing deposits would free banks from the natural discipline imposed by wary depositors. If the government guaranteed the losses, banks might be encouraged to take excessive risks. To, in his words, put a premium on unsound banking, knowing the taxpayer would ultimately bear the liability.
And the bankers themselves weren't fans either.
No, many powerful bankers opposed it, labeling the federal guarantee as socialist intervention that would interfere with their business models and impose federal oversight where historically there had been very little.
So how did it pass? Was it just unstoppable political momentum generated by the crisis?
Exactly. The crisis was so deep and the need to restore confidence was so paramount that the advocates of deposit insurance, Senator Carter Glass and Representative Henry Stegall, they successfully attached the insurance provision to the wider reform bill. Roosevelt signed the Banking Act of 1933 into law on June 16, 1933, and it immediately established the FDIC as a temporary measure.
Let's look at that initial protection. We operate under $250,000 now, but that first limit seems minuscule by comparison.
It started very modestly, which reflects the caution of the time. The initial plan set in 1934 insured deposits up to $2,500 per ownership category.
$2,500.
Yeah, but as you noted, using consumer price inflation, that was a respectable amount, equivalent to about $58,762 today. But the government recognized quickly that this wasn't enough to instill full confidence, so the limit was quickly raised to $5,000 in 1935. That's equivalent to nearly $117,525 today. This early increase really demonstrated the principle that the insurance limit has to be substantial enough to cover the vast majority of ordinary depositors completely.
And the 1933 Banking Act, which is sometimes just called the Glass-Steagall Act, was so much more than just insurance. It was a complete overhaul of the American financial system.
It was revolutionary. Beyond the temporary FDIC, the act extended federal oversight and regulation to all commercial banks for the first time, not just those that chose to join the Federal Reserve System. And of course, the key structural change was the formal separation of commercial banking taking deposits and making loans from investment banking underwriting and trading securities.
Which was the system that existed for decades until it was repealed in 1999.
Precisely. The act also included a lesser-known but historically fascinating provision. It prohibited banks from paying interest on checking accounts.
Really?
Why? This practice was intended to reduce excessive competition between banks for deposits, a factor that many believe contributed to overly risky lending practices in the 1920s. And that prohibition stood for decades until the modern era of financial deregulation.
The FDIC started as this temporary government corporation, but its success during the bank holiday made its permanence pretty much inevitable.
It absolutely did. Public confidence returned almost immediately after the first bank holiday. The government realized they had found the antidote to bank runs. So the Banking Act of 1935 formally made the FDIC a permanent government agency and settled the insurance limit at that $5,000 level.
If we track the march of the limits since 1935, we can see this ongoing effort to maintain that psychological confidence against inflation and economic growth.
It's a clear historical perspective of calibration. The limit stayed stable for 15 years, then moved to $10,000 in 1950. We saw some incremental jumps through the 60s and 70s, hitting $100,000 in 1980.
And that number held for almost 30 years. That became the default number in the American psyche.
It really did. And the most recent and most dramatic increase occurred during the 2008 crisis. The jump to $250,000 was initially a temporary measure, part of the Emergency Economic Stabilization Act of 2008. It was designed to stem the massive fear that was gripping the system. It was later made permanent by the Dodd-Frank Act in 2010. This continuous adjustment shows a government commitment to ensuring that the vast majority of personal, working, and small business savings are fully protected. It's a recognition that the moral hazard risk is now, deemed acceptable if it means preventing systemic panic.
That leads us directly to the question of the structure itself. We keep saying the government backs this guarantee, but we need to clarify, where does the money actually come from? Because the assumption that it's taxpayer-funded is one of the biggest misconceptions about the FDIC.
That is the single most crucial fact about the FDIC's structure. It is not supported by public funds or the federal budget. The system is funded entirely by the banking industry. It regulates and insures. It is an industry-funded insurance pool with a government guarantee.
So how does that work in practice?
The primary funding source is the assessment of premiums, essentially insurance fees on each member bank. This revenue accumulates in the Deposit Insurance Fund, or DIF. And this isn't a flat fee. The premiums are calculated based on a risk-based assessment system.
How does that risk-based system function? Does the FDIC essentially give every bank a report card and then charge the failing students more?
That is precisely what happens. The amount a bank pays is determined by its balance of insured deposits, but the premium rate applied to those deposits is calculated based on the degree of risk the institution poses to the FDIC. Banks that are deemed financially sound, with high capital ratios and low risk, they pay lower premiums. Those with riskier profiles pay substantially higher rates. This mechanism helps instill discipline. It means sound institutions aren't completely subsidizing reckless ones, and it provides a financial incentive for banks to maintain strong capital.
What happens to the money once it's in the DIF? How large is this fund and how is it managed?
The fund is enormous, and it's very carefully managed. By law, the entire Deposit Insurance Fund must be invested exclusively in low-risk U.S. Treasury securities. This investment generates interest, which constantly supplements the premiums paid by the banks. The fund is constantly growing. As of 2024, the DIF stands comfortably over $125 billion.
And there are mandatory targets for the size of that fund established by law, right?
Yes. The Dodd-Frank Act, which came out of the 2008 crisis, mandates that the FDIC must maintain a required reserve ratio. A fund must hold at least 1.35% of all estimated insured deposits. This is a crucial statutory requirement. If the ratio falls below that 1.35% threshold, the FDIC is required to submit a detailed restoration plan to Congress on how they will raise the required amount, typically through increased premiums.
Okay, let's discuss the critical safety net. What happens when a crisis is so large that the DIF is simply exhausted, as happened in the 2008 crisis?
Even when the dues are insufficient, the FDIC is designed with robust fallback mechanisms that provide its ultimate strength. First, it can borrow from the Federal Financing Bank, or FFB, which is a government corporation. Second, it can issue debt through the FFB. But the ultimate guarantor is the direct line of credit it has with the U.S. Treasury, which allows the FDIC to borrow up to $100 billion.
$100 billion.
The crucial point here is that while the fund has been depleted and forced to borrow from the FFB in the past, notably after the S&L crisis in 2008, it has never had to use that $100 billion direct line of credit from the Treasury. The industry-funded mechanism, combined with the power to assess higher premiums and liquidate assets, has always proven sufficient, which maintains the integrity of the not taxpayer-funded claim.
We mentioned a confusing period in regulatory history, the dual reserve funds. This is a detail, but it speaks volumes about regulatory unintended consequences. The Bank Insurance Fund, BIF, and the Savings Association Insurance Fund, SAIF.
This is a great illustration of how regulation can create unexpected market pressures. From 1989 to 2006, the FDIC ran two separate funds. The BIF covered commercial banks, and the SAIF covered savings and loan associations, or thrifts. This division only existed because the FDIC inherited the thrifts' insurance responsibilities after the FSLIC, their original insurer, failed completely during the S&L crisis.
And the problem was that these two funds were in vastly different states of financial health.
Precisely, because the SAIF covered institutions that had just been through a massive, costly bailout. Its premiums were often dramatically higher than the BIF's. This led directly to what Alan Greenspan, who was then the Federal Reserve Chairman, called arbitrage. Banks found ways to shift their insured business from the higher premium SAIF to the lower premium BIF, for instance, by merging institutions or creatively structuring deposits.
So they were playing the regulatory landscape just to save money on premiums.
Exactly. Greenspan pointed out that the government was essentially enforcing two different prices for the same item, deposit insurance, which encouraged banks to arbitrage the difference, increasing instability for both funds. The insight here is that when you create artificial boundaries in finance, the market will find a way to exploit them.
So what was the fix?
The resolution was the Federal Deposit Insurance Reform Act of 2006, which merged BIF and SAIF into the single Unified Deposit Insurance Fund, or DIF, eliminating that arbitrage opportunity entirely.
Moving from funding to action, the FDIC's role extends far beyond just paying claims. It is also a primary regulator. It examines and supervises institutions for safety and soundness. It acts like an ongoing report card issuer for the financial health of every insured bank.
Its supervisory role is arguably its greatest tool for preventing crises. To qualify for and maintain insurance, banks must continuously meet stringent requirements regarding liquidity and capital reserves. The FDIC uses a precise 5-tiered classification system based on a bank's risk-based capital ratio, the measure of its financial cushion relative to its risk-weighted assets.
Let's break down these tiers, because this classification system dictates when and how regulators intervene.
These tiers are the regulatory tripwires. At the top, you have well-capitalized, this is the gold standard, requiring a capital ratio of 10% or higher. These banks get minimal scrutiny, they have the most operational freedom, they are the definition of financial health.
Okay, so that's the goal.
Right. Next is adequately capitalized, requires 8% or higher. These banks are still compliant, but they're getting closer to the warning line. Then you have undercapitalized. This is less than 8%. This is the first serious regulatory tripwire. The bank's primary regulator has to issue a formal warning and requires the bank to submit a capital restoration plan. This is the first sign of mandatory intervention.
So the alarms are going off at this point.
The alarms are definitely going off. Then it gets worse. Significantly undercapitalized is less than 6%. At this point, the regulator can impose severe restrictions. They can force a change in management, restrict asset growth, prohibit the payment of dividends, or force major corrective action to quickly raise capital. And finally, critically undercapitalized, less than 2%. This is the point of no return. Federal law is explicit. The bank's chartering authority must close the institution and appoint the FDIC as receiver within 90 days or earlier if the regulators deem necessary.
So the strength of the FDIC isn't just its ability to pay out $250,000. It's its legal power to intervene long before a bank hits zero, forcing closure at that 2% capital threshold to minimize the eventual cost to the DIF.
Exactly. The system is designed for early intervention. If the FDIC can force a closure at 2% capital, they have a pool of assets remaining to liquidate, which significantly reduces the claim against the deposit insurance fund. The supervisory oversight is the insurance policy against the insurance policy being wiped out.
Okay, this is the most crucial, actionable section for our listener. The $250,000 limit is permanent and backed by the full faith and credit of the U.S. government. But that dollar figure is applied much more flexibly than most people realize. The key is to stop thinking of it as $250,000 per person and start thinking of it as $250,000 per ownership category.
That distinction is paramount. If you only think in terms of $250,000 total, you are dramatically underestimating your potential coverage. The limit is applied per ownership category at each legally separate insured bank. If you understand the rules of titling, you can structure your savings for multi-million-dollar coverage without opening a single new account, just by retitling your existing ones.
Okay, let's first clarify the covered deposits. What types of accounts are we talking about here?
We are strictly talking about deposit accounts, meaning they represent a direct liability of the bank to the depositor. This includes all the standard accounts you use every day, checking accounts, including those interest-bearing and NowW accounts, standard savings accounts, money market deposit accounts, or MMDAs, but only those offered by the bank, not brokerage money market funds, and time deposits, which are certificates of deposit, or CDs. It also covers outstanding negotiable instruments drawn on the bank, so things like official bank checks or certified checks.
And an interesting detail from the source material is the coverage for foreign currencies. That's surprising.
Yes, accounts denominated in foreign currencies, say euros or yen, are still covered as long as the account is held in a domestic office of an FDIC-insured bank. The insurance payment, however, would be made in U.S. dollars, calculated based on the exchange rate at the time of the bank failure.
Before we jump into categories, let's just reiterate the branch rule.
A critical reminder. All branches and associated online platforms of a single bank are counted as one bank for insurance purposes. If Bank A has 20 branches and an online division, you get one $250,000 limit across all of them. To gain separate coverage, you must use a separate, distinct, legally chartered bank.
Now let's dive into the power of the ownership categories. This is how strategic structuring allows a single person to secure coverage far exceeding that $250,000.
We have to drill down on these distinct ownership categories because each one is treated as a separate limit. The FDIC defines 7 distinct categories.
Let's review them. First, single accounts. Owned by one person or a sole proprietorship, that's $250,000 limit.
Right. Then certain retirement accounts. This includes your IRAs, traditional Roth, SAPI, and accounts held by self-directed KIOs. That's another $250,000 separate from your single accounts.
Third, joint accounts, accounts with multiple owners who have equal rights to withdrawal.
Fourth, trust accounts. This covers both revocable or living trusts and irrevocable trusts. They simplified this into one category since April 2022.
Okay. Then employee benefit plan accounts.
Deposits held by pension or welfare plans.
Corporation partnership unincorporated association accounts.
So business entity deposits.
And finally, government accounts.
The real strategy lies in combining these categories across multiple institutions. Let's use the hypothetical example from the source material. A single depositor aiming for $1.5 million in coverage.
Walk us through that calculation.
Okay, take Bank X and Bank Y, two separate insured institutions. At Bank X, you establish 3 accounts. 1, a single account, that's $250,000 insured. 2, an IRA account, another $250,000 insured. And 3, a revocable trust account for your children, assuming 1 beneficiary for now, another $250,000 insured.
So that's $750,000 at Bank X alone.
Total coverage at Bank X, $750,000. Then you repeat the exact same 3 ownership structures at Bank Y. Total coverage at Bank Y is another $750,000. By using 3 distinct ownership categories at 2 distinct institutions, you achieve 6 separate insurance limits, totaling $1.5 million. The limits stack based on the legal form of ownership.
The joint account math is particularly powerful, especially for married couples or, say, business partners who share accounts.
Joint accounts are the simplest way to quickly double coverage. Each co-owner in a joint account is insured up to $250,000 for their share of the account. Since ownership is typically assumed to be equal, 2 co-owners can have a joint account insured up to $500,000.
Yet if you have 3 people.
The account is insured up to $750,000. Critically, this joint account limit is separate from any single account limits each co-owner may have individually at the same bank.
So a married couple could potentially have $1 million protected at a single bank, $250,000 for spouse A's single account, $250,000 for spouse B's single account, and $500,000 for their joint account.
Correct. That's 3 separate limits and 3 separate ownership categories, all at one bank. The key is just ensuring the account record's clearly designated as a joint account and that all co-owners have equal rights to withdraw the funds.
And finally, let's touch on the complexity and the power of trust accounts, which are fundamental to estate planning.
Trust accounts offer the maximum expansion of coverage under a single owner's name, but they are highly specific. For revocable trusts, the coverage is calculated based on the number of unique beneficiaries designated in the trust documentation. The owner is generally insured up to $250,000 for each unique beneficiary, provided the funds are titled correctly and the beneficiaries are named in the bank's records.
Give us a simple example of that multiplication effect.
Okay, say a single owner creates a revocable trust account at one bank and names 3 different unique beneficiaries, say 3 children. In this scenario, the funds in that trust account are insured up to $750,000. That's $250,000 multiplied by 3 beneficiaries. If the trust had 10 unique beneficiaries, the coverage could potentially reach $2.5 million at that single bank. The source notes that there are special rules for trusts with more than 5 beneficiaries, but the core principle holds. The coverage is tied to the number of people who will eventually receive the funds.
It's clear that understanding these 7 categories is the difference between relying on a generalized safety net and having a meticulously engineered financial protection plan.
And understanding the boundaries of the FDIC protection is equally crucial, as this is where most consumer confusion and, potentially costly mistakes occur. The sticker only applies to deposits. It does not apply to investments.
This confusion is rampant because investment products are often purchased right there in the physical bank lobby or through a bank's affiliated brokerage arm.
Absolutely. We have to emphasize this. Stocks, bonds, mutual funds, annuities, and any other securities, including money market funds, which are investment vehicles, unlike money market deposit accounts, which are bank deposits, all of those are explicitly not insured by the FDIC.
And for investment losses due to a brokerage failure, the protection mechanism is entirely separate.
Yes. That protection is provided by the Securities Investor Protection Corporation, or SIPC. And while SIPC is also chartered by Congress, its role is fundamentally different. SIPC protects you against the failure of the brokerage firm itself, meaning if the firm goes bankrupt, steals your assets, or loses its records. Crucially, SIPC does not protect you against a decrease in the market value of your securities. If you buy a stock at $100 and it drops to $10, SIPC provides no protection. That market risk is yours alone.
What about other common aspects people might assume are covered?
Also excluded are U.S. government-backed investments like Treasury bonds, which are already considered the lowest risk available, standard insurance and annuity products like life, auto, homeowners insurance, and of course, foreign investments not denominated in a domestic branch.
And we absolutely must talk about the safe deposit box.
The safe deposit box. This is a classic misnomer. Despite the word deposit appearing in the name, a safe deposit box is not a deposit account under federal law. It is a contractual relationship for secured storage space that you rent from the institution.
So the contents are not insured.
Therefore, the contents of that box, be it cash, gold, or important documents, are entirely uninsured by the FDIC. If the bank fails and the contents are lost or damaged, the FDIC does not step in to replace them. The customer has to seek redress through the bank's receiver process or general insurance if they've purchased it.
We also need to draw a clear line between the two ways money can be lost: failure versus fraud. FDIC insurance only covers institutional failure.
That's a vital distinction. Deposit accounts are only insured against the failure of a member bank, meaning the regulator closes it due to financial insolvency. Deposit losses that occur due to the bank's day-to-day operations, such as internal theft by a rogue employee, external fraud, or simple accounting errors, must be addressed through the bank itself or through standard criminal and civil legal channels. The FDIC insurance mechanism is not designed to replace local law enforcement or internal controls against fraud.
Finally, let's tackle the modern challenge of financial technology or fintech companies. This is a massive area of confusion, especially as non-bank entities advertise that they offer FDIC-insured accounts.
This is perhaps the most important boundary for the contemporary listener. Deposit insurance does not cover the failure of the non-bank fintech company itself, like a popular payment app or a digital wealth manager. The consumer protection only exists if, and only if, two very specific conditions are met.
Condition 1 being the money must successfully reach an FDIC-insured bank.
Yes, that's pass-through insurance. The fintech company essentially acts as an intermediary, holding customer funds in a pool and then sweeping or transferring those funds into a deposit account at one or more FDIC-insured partner banks. The problem is the moment of transfer. If the fintech company collapses due to mismanagement or insolvency before successfully placing the money into the insured bank account, those funds are unprotected.
That moment between deposit and sweep is the risk gap.
Precisely. Furthermore, even if the money reaches the bank, Condition 2 involves proper titling. For the deposit to be covered under the full pass-through protection rules, the fintech company must correctly maintain records showing that the funds belong to you, the ultimate customer, and not to the fintech company itself. If the money is commingled, or if the titling information is incomplete or faulty, the deposit could be treated as belonging to the fintech entity, which means it only gets one $250,000 limit, which would be shared among thousands of customers.
So the listener needs to look past the app interface, confirm exactly which FDIC-insured partner bank is holding their money, and verify that the app is practicing meticulous record-keeping to ensure pass-through coverage.
The protection is not inherent to the digital platform. It is strictly tied to the federally chartered and regulated bank holding the deposit. You are essentially using a modern interface to access a 1930s-era insurance guarantee. Transparency about the partner bank is absolutely key.
Despite the FDIC's intensive supervisory efforts, that 5-tiered capital classification system we discussed, banks do fail. When that 2% capital threshold is hit, the FDIC transitions from being a regulator to a resolution entity, stepping into a complex, dual legal role.
When a bank is deemed critically undercapitalized, its chartering authority closes it, often late on a Friday afternoon, and immediately appoints the FDIC as the receiver. Think of the FDIC as two different, legally separate personalities. One is the corporate entity, the insurer, who writes the check to pay the claims up to $250,000. The second personality is the receiver, the property manager or liquidator, who steps in to clean up and sell off the assets.
What is the goal of the receiver?
The receiver's overriding mandate is defined by the least costly resolution principle. They must protect insured depositors, but they must also maximize recoveries for all creditors, including those with uninsured funds. The receiver legally succeeds to all the rights and privileges of the failed institution, its officers, and its stockholders. It then manages the liquidation process, marketing and distributing the proceeds from the bank's assets.
That least costly rule dictates which resolution method they choose. What are the two primary methods the FDIC employs today?
The FDIC has two core methods, and they will always default to the one that costs the deposit insurance fund the least amount of money.
The first and most desirable is the Purchase and Assumption Agreement, or P&A.
A P&A is the preferred method because it maintains market confidence and ensures the least disruption to depositors. In a P&A, the FDIC finds an open, healthy bank that agrees to assume the failed bank's deposits, which are the liabilities, and purchases some or all of its loan portfolio, the assets. This transfer typically happens over a weekend. Depositors transition seamlessly to the new institution, often only noticing a name change on Monday morning. The continuity of service is the main benefit, and the assets that are sold immediately help minimize the FDIC's loss.
The second and less common method is the deposit payoff.
This happens if no suitable healthy bank can be found for a P&A. Perhaps the failed bank's asset quality is too poor or the timing is difficult. In a deposit payoff, the FDIC, acting as the insurer, immediately pays all depositors with insured funds the full amount, usually within a few days. Those with uninsured funds, the balance over $250,000, and other general creditors, like suppliers, receive receivership certificates. These certificates entitle the holder to a portion of the receiver's collections as the failed institution's assets are slowly liquidated.
So if a listener had $350,000 in a single checking account, they would get $250,000 back almost immediately, and then a piece of paper, the certificate representing the $100,000 uninsured portion, which may or may not be repaid depending on how the bank's assets sell off.
That is exactly the situation. The immediate $250,000 is guaranteed. The $100,000 is a claim against the remaining assets. Historically, recovery rates vary widely, but depositors often recover a large percentage of their uninsured funds, so it can take months or even years.
We also must dedicate some time to the resolution plans, or living wills. This massive regulatory burden was created by Dodd-Frank, specifically for systemically important institutions.
This is a direct answer to the too-big-to-fail problem revealed in 2008. The Dodd-Frank Act requires large, covered institutions, those with $50 billion or more in assets, especially the global ones, to submit highly detailed resolution plans. These plans are essentially blueprints for how the FDIC would orderly resolve the bank if it failed without causing systemic collapse or requiring a taxpayer bailout.
But the operational challenge of breaking up a massive, interconnected financial institution like, say, a major Wall Street bank must be astronomical. I mean, these banks operate globally.
It is astronomically complex. The FDIC requires these banks to plan for a failure scenario. They have to identify critical functions, lines of business that can be separated and sold, and how to maintain essential continuity like clearing and settlement systems during resolution.
What are the strict planning assumptions the FDIC mandates for this?
They are designed to eliminate magical thinking and force realism. 1. The plan must assume the covered insured depository institution, or CD, must fail. There is no bailout. 2. The failure must be caused by a core business loss or impairment, not some external political event. 3. The plan requires analysis of a multiple acquirer strategy, how the institution could be broken up and sold in parts rather than finding one single buyer. And crucially, for globally active firms, the resolution plan has to address cross-border coordination. They have to show how the U.S. resolution would align with the regulatory frameworks in Europe or Asia, ensuring that the U.S. resolution doesn't cause a cascade failure in foreign markets, which would only make the U.S. failure worse.
So the purpose of the living wills isn't just to prepare the FDIC, but to force the banks to structure themselves in a way that makes an orderly failure possible.
Exactly. The plans must demonstrate that the bank is resolvable. If the FDIC and the Federal Reserve jointly decide that a bank's plan is not credible, meaning it cannot be resolved without systemic disruption, they can impose serious penalties, including higher capital requirements or even forced divestitures. It's a regulatory gun pointed at the heart of complexity.
To truly appreciate the strength of the FDIC today, we have to look at the two defining financial crises where the agency itself nearly broke and how those challenges forced fundamental evolution and reform.
The S&L and bank crisis of the 1980s and early 1990s was the first major systemic test of federal deposit insurance since the Great Depression. The system fractured because the institutions themselves were fractured.
This was the period where the separation between banks and S&Ls proved fatal. Right.
It did. The S&L crisis was fueled by deregulation, allowing S&Ls to make riskier loans and investments, combined with high interest rates that made their traditional long-term mortgages unprofitable. The institution tasked with insuring savings and loans, The Federal Savings and Loan Insurance Corporation, or FSLIC, it just ran out of money and failed completely. It was insolvent.
That failure forced massive government intervention.
Yes. The FSLIC was abolished in 1989. Congress created the Resolution Trust Corporation, or RTC, to take over the task of resolving the hundreds of failed thrifts. The RTC then engaged in the largest real estate asset liquidation in history. The sheer magnitude of the resulting taxpayer liability is just stunning.
Let's reflect on that cost. $123.8 billion in U.S. taxpayer losses. That's a staggering amount.
It was approximately 81% of the total resolution costs, and it proved Roosevelt's moral hazard concern on a grand scale. It demonstrated that when an insurance system is fundamentally underfunded and poorly managed, the taxpayer is the ultimate backstop. It was a failure of supervision and funding that cost the country enormously.
And the crisis didn't spare the FDIC's own bank insurance fund, the BIF, either.
No, the BIF was exhausted in 1990 due to the high volume of commercial bank failures that occurred simultaneously with the S&L crisis. At that point, the FDIC had to use its emergency funding option, borrowing $15 billion through the Federal Financing Bank. However, the system worked. The FDIC increased premiums and aggressively liquidated assets, managing to repay that entire debt by 1993. The legislative response, including FDICIA, made the agency much stronger, imposing new mandatory capital requirements and solidifying the early intervention rules we discussed earlier.
Fast forward to the greatest modern stress test, the 2008 financial crisis.
That was a challenge of complexity and scale we hadn't seen before. Between 2008 and 2017, the FDIC resolved 528 institutions, peaking with 157 failures in 2010. These included massive, high-profile collapses. Washington Mutual, for instance, became the largest bank failure in U.S. history to date.
The panic was intense, and there was a dramatic internal debate among government officials about how far the FDIC guarantee should stretch.
Absolutely. The Federal Reserve and Treasury officials, fearing total market collapse, proposed using the FDIC's authority to guarantee virtually all debt across the financial sector, including investment banks. The then FDIC chairman, Sheila Bair, famously resisted this, arguing that the FDIC's authority was designed to protect depositors, not bondholders or investment banks.
That resistance led to a more targeted response.
Yes. The compromise was the Temporary Liquidity Guarantee Program, which focused on guaranteeing interbank lending and specific unsecured debt instruments vital for day-to-day payments, alongside the temporary increase of the deposit insurance limit to $250,000 to instantly shore up consumer confidence.
Even with that temporary limit, the deposit insurance fund was exhausted again by late 2009. How did the FDIC navigate that without appearing to rely on the Treasury?
It was a bold and necessary move. Failures like the $5.6 billion payout for Bank United completely drained the fund. Instead of tapping the Treasury line of credit, the FDIC demanded 3 years of advance premiums from its member institutions. This allowed the agency to temporarily operate the fund with a negative net balance, essentially carrying a negative equity that the industry was legally obligated to repay. This maneuver was crucial because it allowed the FDIC to manage the crisis resolution without explicitly costing the taxpayer at the moment of peak failure.
And the final legacy of that period is the sweeping Dodd-Frank Act of 2010.
Dodd-Frank codified the lessons of scale and complexity. First, it made the $250,000 limit permanent, retroactively covering failures that occurred from January 1st, 2008. Second, it provided the FDIC with new, critical authority to address risks associated with the largest systemically important financial institutions, codifying the living wills requirement we discussed earlier. And third, it permanently institutionalized the commitment to fund the DIF to that 1.35% minimum, requiring a restoration plan if it ever falls below that line.
The DIF fund eventually returned to a positive balance in 2011 and met its required 1.35% minimum in 2018. It is truly a remarkable story of an institution that learns, adapts, and self-corrects based on historical stress tests.
We have mapped the full journey of the FDIC from a controversial, grudgingly passed experiment opposed by the very people it was designed to save to the absolute bedrock of U.S. financial trust.
Its mission-insured deposits is deceptively simple, but its mechanics involve complex historical precedents, a rigorous, risk-based funding mechanism entirely paid for by the banks themselves, and a highly specific legal process for winding down failed institutions.
So what does this all mean for you? You now know that your protection is not based on a generalized safety net, but on a legally structured contract based on precise ownership categories at different institutions. It gives you the power to structure your savings strategically, knowing that the full faith and credit guarantee is tied to those specific rules of titling.
And here's where it gets really interesting. The biggest tool the FDIC has isn't its checkbook. It's the power to regulate, specifically through that five-tier classification system, where a bank at 10% capital is well capitalized and a bank below 2% is mandated for closure.
This raises an important question. While the FDIC's immediate goal is protecting you, the consumer, the supervisory classification system is the key predictor of institutional stability. The agency requires banks to be transparent and publishes quarterly reports detailing bank financial performance, including that crucial leverage ratio. The entire industry is aiming to stay well above that 10% well-capitalized line because dropping below 8% triggers severe regulatory intervention.
It's the metric that keeps the insurance from ever being necessary.
Exactly. So here is the final thought for the listener to explore. We have seen how financial confidence is the ultimate safety feature. How accessible is your own bank's current capital standing today? And how does the current financial climate pressure that 10% well-capitalized threshold? This classification system, designed to prompt early intervention and minimize disruption, is the mechanism that ensures the sticker on the window remains a promise, not just a hope. Knowing where your bank sits in that five-tier system gives you a deep, actionable insight into the stability of the institution holding your assets.